Non-owner occupied properties. Oh, sorry, this is a chart where I look at different annual values. For up to 8,000, let's say exactly 8,000, currently you will be paying property tax of $80. But with the new regime coming in, you actually don't pay tax. At 36,000, this will cover a lot of people. 5-room flats, executive flats, condos. So usually condos will hover around 30,000. So you actually also have a fall in property tax from currently 1,002 to 1,120. Okay? So the government is actually looking at the middle income group, recognizing that they are stretched and not taxing them. But the well-to-do, if you look at the last 10 years, the income has increased substantially, but the tax has gone down quite a lot. So now the government is trying to reverse it. So at 72,000 would be about a semi-D. So if you stay in a semi-D, currently you pay 2,780. Going forward, you pay marginally more, not that much more. $90, less than $200 more. So only very marginal. But if you stay in a bungalow, you pay quite a lot more. Because at AV of 200,000, currently you're paying 10,460. Next year, 19,230, and then onwards, 20,580. So your property tax will be about just double. And I think this is good. Some people call it the Robin Hood budget, but I call it a caring budget, right? The government should pay attention to the lower income group. And non-owner occupied properties currently is at 10%, whether it's commercial or residential. But for residential, the rates are going up substantially. So currently, our maximum is 10 flat. But from next year, we will have progressive property tax for non-owner occupied residential properties. So from 10 going all the way to 19%. And 2015 onwards, it will double for properties in excess of 90,000 to 20%. Notice the government has also looked at owner-occupied and non-owner-occupied differently. For owner-occupied, we only hit a maximum when AV is more than 130,000. But if you are rich enough to rent out your property, then the top rate kicks in at 90,000. So again, I have this chart. Currently AV 10,000. So this would probably be your 3-room HDB flat or your 1-room studio flat. You will not be affected. It's 1,000 under old rates, under new rates. So if you rent out a smallish apartment, you will not be affected. Even at 50,000, the increase is only 10%. So at 50,000, you're talking about quite a decent condo that you're renting out. At 100,000, the increase eventually is 40%. So at 100,000, you're talking about pretty high-end condos. And then 200,000, increase of 70% to 34,000 from the current 20,000. So quite substantial increase. But more painful change is the abolition of the vacant properties concession. So from next year, it doesn't matter whether your property is occupied or vacant, you will have to pay property tax. And to me, this is a very good move because a lot of people have been complaining. Overseas investors have been buying up properties, but they don't rent them out. When they don't rent them out, first of all, they are denying people here for rental of properties. And secondly, they don't pay property tax because they get the concession is vacant. But going forward, if you keep your investment flat, investment condo vacant, you have to pay property tax. And if you're looking at a mid-level kind of condo, you have to pay 14,000 property tax. And to me, that is a good move to address people buying properties but not letting them out. So now I think property prices will begin to ease, and also rental will begin to ease, because now if you leave your flat vacant, you still have to pay property tax. Probably you would then consider letting your property out. So probably rentals may ease. Well, for recent developments, I just want to spend a few minutes talking about 3 pretty interesting cases. The first case is the HSBC Institutional Trust Services versus the Chief Assessor. In fact, the owner is not HSBC Trust Services, it is Capital Mall, okay? Because they run a REIT, so the trustee is HSBC Trusts. Basically, the argument here is on the annual value. Remember, commercial property tax is 10%. So Capital Mall contended that when they charge rental consisted of depreciation of escalators, lift, air conditioning plant, and fire safety systems. So they say, well, this is actually depreciation, is not part of renting out of the property. It should never factor in to compute the annual value, because when your annual value increases, your property tax will increase. When it went to the board agreed with Capital Mall that AV should exclude the depreciation element, because the board held that the depreciation of this plant, escalators, air conditioning plant, and so on, has nothing to do with the rental of the units in Capital Mall. In this case, they were talking about Bugis Junction. IRAS objected, went to High Court. High Court held that the depreciation should be included, because the court held that when you rent out your premises, the lift, the escalators, fire safety system would be an integral part of the building. You can't separately let out all these elements. So the High Court held that the so-called depreciation element should be included. Capital Mall appealed to the Court of Appeal, and in fact, the Court of Appeal just made the judgment in January. And they concurred with the findings of the High Court that the rental is a rental of everything. So if your assets, even though they are plant, but they are integral part of the building, the rental charge is actually for the building, including the integral parts. Okay, so going forward, landlords of commercial buildings cannot try to contend. In fact, the amounts were quite substantial. They were looking at many millions of property tax exposures. Now, this is an interesting case, AYN Corporation versus Commissioner of Income Tax. The question here is, AYN, a Japanese company, had an old branch. It had a branch in Singapore registered in 1992, but because it had been incurring losses, it was deregistered in 2004. But 2006, AYN registered another new branch. So the new branch sought to claim the losses previously incurred by the old branch, quite substantial. The losses amounted to 30 million. So, well, we had 30 million loss carried forward, therefore these should be available for set-off. IRAS said no. We have always treated branches as separate. And they also quoted the Article 7 of the Singapore-Japan Treaty, because the Article 7 deals with business profits. And part of the Article 7 says when you have a permanent establishment, the permanent establishment shall be treated as though it was separate and distinct. But the court held that no, a branch is a mere extension of the head office. AYN is still there, so when it sets up a branch, it is just extending itself. The losses of 30 million was incurred by AYN and therefore available for set-off. Okay? Now it's available for set-off. But unfortunately, there are undesired outcomes arising from this AYN case. Because up until now, IRAS had always treated branches, PEs as separate. I have clients with one branch here, and when they have a new project, IRAS will issue them with another return. So when you have two returns, you have two lots of partial exemption and two lots of PIC, because each entity will be allowed 400,000 per activity. Now IRAS is saying, well, we will want all these to collapse into one, because now the court said all your presence in Singapore is a mere extension of the head office. So that's the undesired outcome from the AYN case. Well, the AQQ case has stirred a lot of interest because this was an anti-avoidance case. So those of you who have been practicing previously would be aware that up to 2003, we had the imputation system. So under the imputation system, companies, when declaring dividends, have the tax previously paid attached as a tax credit. So when they introduced the one-tier system, they said, well, the credit will disappear at the end of 2007. So there was a 5-year transition. So basically in the AQQ case, what happened was they actually had a lot of Section 44, but they couldn't make use of it. If they can't make use of it, by 2007, these would be gone. So what they did was they restructured themselves. It is a listed company in Malaysia, but they have a few entities in Singapore. So the Singapore entities, they had a restructuring to put them into different lines of business. So a new holding company was set up to hold these subsidiaries. Total consideration that the new company AQQ has to pay its parent, AQQ is owned by the parent, was 225 million. AQQ borrowed from the bank 225 million through the issue of a convertible note, interest rate at 8.85%. The bank turned around, stripped off the interest coupon, sold the principal to its bank in Mauritius. So it sold 205 million and had an advance purchase agreement for the next 20 million. Mauritius sold it to a wholly owned subsidiary of the parent for 225 million. This new company had no money, so it borrowed from the parent to lend to this subsidiary, which paid Mauritius, Mauritius paid Singapore. So basically, when AQQ paid 250 million, there was no money transfer. Money borrowed from the bank actually came from the parent. It's just a loop. But by doing that, they created a lot of interest expense. So when subsidiaries paid dividends to AQQ, dividends taxable, but because they have $225 million of convertible note, interest was close to 20 million. So they declared just over $20 million of dividends, set off interest, no tax to pay, thank you very much. Tax refund every year. At that time, still about 30%. So 20 million dividend, 6 million refund every year for the next 5 years. Very nice. Of course, IRIS is not happy. This is anti-avoidance. Your objective is to avoid tax. Went to, of course, AQQ appeal. Went to Board of Review. Board of Review said, well, it's anti-avoidance. But AQQ appealed to High Court. And High Court held that, well, the financing part was anti-avoidance. But the receipt of dividend is not anti-avoidance, it's a commercial situation. So with a very fine definition, they say, well, IRIS has no right to issue additional assessments. Okay, so everyone was very excited. For the first time, IRIS had been knocked in the knuckle for invoking Section 33. Bad news, IRIS is going to appeal to the Court of Appeal. So the story hasn't ended, but my story has. So ladies and gentlemen, thank you very much.
Thank you, Professor Sum, for the insightful presentation. Before we head off for the tea break, I would like to invite the audience to participate in the ICPAS membership survey, which can be found on our corporate website. This survey aims to understand your needs and priorities and how we can reach and serve you better. We appreciate your help to complete the short online survey and thank you in advance for your participation. In addition, CCH and LexisNexis are offering good discounts on selected book items at 15% and 20% respectively. You may browse the items available at their booths outside. I shall not continue to stand between you and tea break. Kindly make your way outside the ballroom where a delicious array of items awaits you. We will see you back here at 11:30 a.m. for the panel discussion. Thank you.